What's up, everybody? It's the Digital World Podcast. What I want you to see here is the 30-year yield, right? And like I said, a lot of this stuff may seem like I'm just being repetitive, but the reason why I'm bringing this up is because bonds are something you need to be paying attention right now. Now, this is a chart. This is a monthly. Each candle represents 1 month, okay? And I mean, I don't like that these charts don't go all the way back, right? So I'll go to this chart here from the Federal Reserve um, data, Fred. And so my point is, since 1981, we've had a bull market in bonds. Okay, the yield was at its max at 15%. Ever since then, the yields have been coming down, but the face value of the bonds have quote unquote increased. Okay, now keep this in mind, right? Because I'm going to be going changing charts here. Um, when I go to here, the last 10 years, it's hard to, let me see if I can, nope, I can't. If I go back to the chart over here, we look at our bottom that occurred in approximately, let's see here, the 2nd of March 2020. Let's see. Yeah, around that 2020 time period is when we had approximately our low. Okay. Now, when looking at this, right, we have all this data from years, right, decades. Within a 5 year period, you'd be able to tell if there was a change in trend. So from 2000 to 2006, looks like it's coming down, right? There's no clear change in trend. But right here, March of 2020, our literal bottom from a trend that's happened for 40 years. All of a sudden, that marked our bottom, and you saw a reverse in bond yields. Okay? The reason I keep bringing this up and it's going to be a conversation is because could it be like we look at our charts from 30-year mortgage rates, our peak was in 1981. Could it be that our bottom, which occurred in 2020, marks the low point of mortgage rates? And what we're about to see, and this is where I'm asking the question more so than making a statement, are we about to see mortgage rates go up? So people think they're high now, but could it be that this is nothing in comparison to what's coming? Because if this was a multi-decade trend in bond yields, and people use investors, whether it be domestic or foreign, are looking at these and saying, where is this going? Could it be now that this multi-decade trend has reached its bottom and is now reversing? Now, my point is to say that when it comes to bonds, you don't know that the trend has reversed until you're far into it. So we may not know until 10 years in, hey, this trend has reversed, we're headed the opposite way. And if you see, let me go back to my chart here. If you see that we break out and the 30-year goes beyond 516, I think you're going to start to see a lot of panic set in with people. And that brings me to my next point. Jamie Dimon. Listen to what he says.
You know, these are very large numbers. You've seen it a little bit. You know, you had the crack in the bond market in COVID a little bit. You know, the government did the right stuff, then they massively overdid both spending and QE. We borrowed and spent $10 trillion from 2020 to today. Okay, and you heard the numbers before, we also bought $4 trillion of your securities, on top of the $4 trillion we bought in the first go-round. Those numbers are true globally, not quite as big as ours, but the QE of us was $8 trillion, the QE of the rest of the world is another $8 trillion, something like that. You're talking about huge sums of money. You don't really know the full effect of that. And the bond dealers, which Gary mentioned, inventories are much smaller than they used to be, partially because of rules and regulations, and you are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some over in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then something my friends will tell me that we like crises because it's good for JP Morgan Chase. Not really. I tell people when Credit Suisse went bankrupt the first.
Okay, so you heard that? That's the part that I wanted you to pay attention to, is this one.
Smaller than they used to be, partially because of rules.
You're going to see a crack in the bond market. It's going to happen. I am telling you it's going to happen, and you're going to panic, and I'm not going to panic. What I'm telling you right now is that crack in the bond market would be yields going higher. Yields go higher, your mortgage rates go higher. What happens to the value of your home price? It gets lessened. So we saw a euphoric rise, right, in the housing prices. What were home prices at these rates? I can tell you they're sure a lot less cheaper than they are today. And so if this ends up panning out and you see another jump up, a leg higher, I can tell you right now, we'll see that the trend is going to continue in that direction. But the trend is your friend, right? So you look at that and you acknowledge it, and this will have a lot of effects down the road. One thing that a lot of people usually look at the 10-year yield, and here is Grog explaining. So I asked, why do people pay attention to the 10-year yield? And these are the reasons why it gives it. The 10-year yield serves as a reference for various interest rates, including mortgages, car loans, and corporate bonds, right? It's for a variety of things. I like to look at the 30-year, like I explained in previous episodes, because there's the strong positive correlation between the 30-year bond and the 30-year mortgage rates. Okay, economic health signal, stock market influence, Federal Reserve policy clue, global capital flows, and inflation expectations. 10-year is a pulse on economic expectations, influencing everything from personal finance to global markets. It's watched closely because it distills complex economic dynamics into a single number. Okay, folks, I think this right here tells you a lot of what you need to know. If you bought in Austin, Texas during the peak of June 22, the value of your home is already almost down 23%. If you bought a medium-priced house, you lost $133,000 up until this point. So, what you see, each market, the point is trying to make is each market is different, right? You can't go based off the national averages, because each market can be hotter or can be colder. Essentially saying there could have been higher rises during that time period, but there could be larger declines, right? So each individual state, city has their own different metrics. And what he's telling you is there's been a huge price drop since the peak in June of 2022 in Austin, Texas. And so what I'm telling you right now and what I'm trying to get across to people is we need to watch this 30-year bond. If we see what Jamie Dimon says is you're going to see a crack in the bond market, what you're going to notice is this is going to keep increasing. And what folks are going to keep doing is they're going to stop dropping the prices of their homes. And so, and folks, to reiterate, when the bond market turns direction, we're talking about multi-decades worth of a trend. And if we are just on the beginning stages, we're just 5 years into this thing, you could potentially have 35 years left of this, which means what does that do to the value of your house? It's just a question. And if we're going to see a crack in the bond market and this trend is going to continue, does that mean home prices come down over the long-term horizon? Makes you question, right? Makes you wonder. And that is why I'm bringing this up. And that's why I want to get this out there so people understand that we need to keep monitoring this bond market and where it's headed. All right. Well, I'd like to know what are you guys seeing in your area? Let me know what kind of deals, what kind of sales what kind of home prices you're noticing. But this is very imperative. Thank you for watching. Like and subscribe to the channel. This is the Digital World Podcast, and I'll see you in the next episode. Have a good one, everyone.